to support food shortages. As we are aware, we've had a bit of crisis and conflict in Northeast and North Central for a while now, and that has affected food production. Indeed, agri production was down, to one of the lowest in more than a decade in Q2 2018. So that shows that domestic production is still very weak, and we might need, imports to supplement that. Similarly, we know imports is very, very important to manufacturers. So inputs, for instance, wheat is very important to consumer goods companies. So you need to import all these all these inputs to sustain your operations, to make sure that your goods get to the market. So for us, we believe imports are a sign of consumer spending, and it is important that we continue to see modest growth in imports, at least to ensure that there's food security and to sustain manufacturing operations.
Adedayo Bakari, macroeconomic strategist at AfroInvest. Thank you very much for coming through to us live from our studios at the Nigerian Stock Exchange. We'll have the rest of the week to talk a little bit more about Godwin Emefiele's final speech to the bankers in 2018. Of course, we go back to the markets. Let's remain on the markets, treat as it were, on the debt market, where the fixed income will be in very strong news round this week. Last week was quite very heavy as the central bank conducted 3 rounds of open market operations, nearly 700 billion naira to mop up aggressive liquidity that came through FAC, the repayment of treasury bills, the bond coupon as well, quite a lot of money. Then this week, we have another very heavy matured treasuries coming through on Thursday. So that tells you that the regulator will start from today to mop it up. So let's mop it up a little bit. Let's get Rita Chimeneme, who is a fixed income dealer at Access Bank. She's joining us live from the FMDQ Exchange Place in downtown Lagos. Good morning, Rita. Hope you had a very nice weekend.
Good morning.
Yes, it's good to see. It's good to see you. When there's so much liquidity on Market Street, you dealers seem to be in a very upbeat mood. So that was last week. What's your outlook on this week?
My outlook on this week.
Oh no.
Okay. December, okay. We're expecting about 2.2 trillion maturing. So there's a lot of liquidity that will be pumped in this month, December, coming from maturities. And of course, we're expecting FAC allocations, credit into the system this week as well. So, I mean, there will be a lot of liquidity, and we expect the central bank to use their tool of open market operations to mop up these liquidities in the market.
Okay, but let's step back a little bit to last week, and we saw the same aggressive treasury auctions by the central bank, and of course the rates were moving in different directions. Give us a summary of that. Do you think the yield curve will likely play out last week like we're going to look at for the current week?
Yeah, I think central bank we expect the yield to inch up slightly again, because if you look at even the primary auction maturities, there won't be any PMA again for the rest of the year until 3rd of January. So some of those maturities will be repaid, and all that will be featured into the market. So I expect the central bank to be aggressive in mopping up this liquidity, as I earlier mentioned, about 2.2 trillion. So for them to maintain the stability of the liquidity in the system, they had to come up a bit bearish at their end. So we expect yields to slightly go from current levels.
Okay, so what's your outlook on this rate? If the central bank keeps coming in to take this liquidity off the floor, as it were, what level are you looking at? We've seen 14.75. What do you see?
Last week already, we've touched 15. The last open market operation as of Friday closed at 15%. That's a yield of 17.1 as we speak. So, I mean, given the maturities that are still outstanding, from the speculations and from the analyst expectations, we see it touching up to 16% by close of the year.
Okay, Rita, just hold on a second. You folks don't power down yet. We'll come back to you after the break. We need to take a quick break. We'll come back to you for just 1 or 2 more questions. We'll be right back into everyone. Okay, let's continue the show. Let's get back to Rita very quickly at the FMDQ exchange place. Rita from Fixed Income Dealer with Access Bank. Rita, thank you very much for sticking by. I just want to clear this up a little bit. About 15.41% on average yield curve last week. So you say effectively 17%. Do you think this is very high? Is it sustainable?
Not really, but what we are saying is that given the liquidity that we're expecting into the money market, there will be fat credits, and we have said that the outstanding OMO maturities is about 2.2 trillion. The PMA, about 78 billion that will be maturing again this month, will be repaid by the central bank, by the DMO, by the debt management office. So we see all this liquidity coming in. Central bank has to struggle a bit to maintain the level of liquidity they want in the system, as well as keeping the exchange rate stable. You can see that from the last the CIBN meeting, the central bank, the last meeting that was held over the weekend, we saw the central bank saying that he would ensure that the FX market and the FX market is maintained at this level, and he will ensure he pumps in a lot of forex to maintain the market at these levels, and as well to intervene in the parallel market. We see them increasing, exchange, them coming every Thursday at 15,000 per week. So that would ensure that a bit of stability at the FX market. So we are saying, given the level of liquidity that will be coming in the money market from now to the end of the year, we see the rates yields go up so that they can contain and keep the liquidity at the levels that will be desirable by the central bank. So 15% was what was closed on Friday, which is an effective yield of 17. We see them hinge up slightly to ensure that this liquidity is mopped up from the system by the end of the year.
Rita, Chairman, Fixed Income Dealer at Access Bank, thank you very much for your time, bringing us up to speed to start the new month of December from FMDQ Exchange Place. As she was saying, over there from Thursday this week, the central bank, of course, to remind you, will start this $15,000, which will be sold to each Bureau de Change operator. That's starting on December the 6th. That's Thursday. The intervention, the regular interventions by the central bank, Monday, Wednesday, and Friday will continue. That's in addition to the $15,000, which is a special intervention at the FX market, which the financial regulator explained last week, because the central bank expects there's a surge in dollar demand as we get to the end of the year. And of course, there were some concerns whether the decline in oil prices will precipitate a dollar shortage. So folks are going in there. But as you have heard this morning, oil prices coming back very strongly, very strong handshake between Russia and Saudi Arabia, getting oil prices back on track ahead of their December 6th, Thursday. It's going to be a critical number of meetings around the world, and the OPEC meeting in Vienna is one of them. Oil prices, Brent crude, 62.25 early today, and it's still in the green territory. So that is maybe erasing those fears that there'll be a dollar shortage. But the central bank, as we have heard, the governor, Godwin Emefiele, says on Friday, the regulator is standing by to defend the Naira. That's about all for today. I hope you enjoyed. Let's see you together tomorrow, Tuesday, the 4th of December. I'll be back then. Have a great day, everyone.